European stocks fall after French President Emmanuel Macron's surprise decision to call parliamentary elections he's forecast to lose. We preview the Fed's decision this week and find out what US inflation is expected to do. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ New Zealand chief economist Sharon Zollner talks about why she sees the Reserve Bank cutting in February next year rather than May.
When we look at what firms are telling us, both in the Business Outlook survey and directly, we're more convinced than the Reserve Bank is that we really are in an environment where firms are finding it really difficult to pass cost increases through.
But first, in 5 and 5 with ANZ, European markets weakened overnight after French President Emmanuel Macron called a snap election. Europe's broad stocks 600 index was down 0.3%, while the FTSE 100 closed down 0.2%. The euro was down 0.4% against the US dollar at 4 a.m. Sydney-Melbourne time. The dollar index up 0.25%, although the Aussie and Kiwi dollars both showed strength. The Aussie was up 0.4% at 66.07 US cents, and the Kiwi up 0.2% at 61.22. US Treasury yields were also up 1 to 5 basis points. Stocks were holding on to their gains, the S&P 500 up about 0.15%, amid wariness around that French election call. The big driver for markets will now be this week's Federal Open Markets Committee rate decision on Thursday morning Australian time. ANZ senior rate strategist Jack Chambers says the key forecast to watch out for is the Fed's famous dot plot of where members believe interest rates are headed.
We're expecting that they will essentially remove one expected cut from this year. At the moment, the median dot plot has 3 cuts for this year. It's likely they'll reduce that to 2. The more hawkish surprise would be, or the bigger surprise would be if they reduced that as far as only having 1 cut as the median for this year. That seems less likely, but that would have significant market implications in terms of higher yields.
Number 2. The last big pieces of data ahead of the FOMC meeting were for the US labour market. That was on Friday night. Non-farm payrolls jumped 272,000 in May, much stronger than expectations for 180,000. But the unemployment rate also ticked up to 4%. ANZ head of G3 Economics, Brian Martin, says the jobs growth was concentrated in health, education and government, indicating deceleration in private sector employment.
All in all, a decent labour market report. I think one that shows the soft landing or no landing for economic activity, still the central case for the moment, but also some signs that the labour market is continuing to rebalance within that. And that means that underlying inflation pressures should ease, even if non-farm payroll growth is still strong.
Number 3. US demand helped drive China's exports up 7.6% in May from a year ago. That was higher than market expectations. ANZ senior China strategist Xiaopeng Jing says that's due to front-loading of exports ahead of Biden administration tariff hikes due on the 1st of August. Strength was also underpinned by a global manufacturing recovery.
We believe that both reasons will contribute to China exports. Exports still has the room to improve in the next few months. However, import is only 1.8% year-on-year in May, signaling insufficient demand in domestic economy. We believe that the structural weakness in domestic market will continue to be dragged to import.
Number 4. In the immediate aftermath of India's election results, the Reserve Bank of India held its policy rate at 6.5%. The RBI increased its growth outlook for the year to March, but maintained its CPI forecast. ANZ economist Diraj Nim says while the RBI maintained a hawkish stance, there was growing dissent within that.
There were 2 members out of 6 which now dissented to status quo on rates and stance. Both of them wanted a rate cut as well as a shift of stance to neutral. So that was an important change. A further decline in current and future inflation on a sustained basis, specifically for the food component, remains the necessary condition for policy easing. We expect the first rate cut in December 2024.
Number 5. The other big focus for global financial markets is US CPI inflation data for May, due tomorrow night. Jack Chambers is looking for around 0.25%, down from 0.3% in the first quarter.
The thing to really look at there is what we've seen in the last month or two is a bit of a decrease in the breadth of price increases. That's what the Fed will be looking for. Do we see most of the basket showing further disinflationary pressures? And that insofar as there is things where the overall level of inflation is still a bit too high, is that really concentrated in just 1 or 2 sectors which reflect lagged impacts? So things like shelter or insurance premiums.
Jack Chambers there. Now, in our bonus deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner explains the thinking behind a change in her team's official cash rate call, from a cut next May to a cut next February.
Now, that's still a long way away, and that does reflect that there's still a long way to go in this inflation fight. But when we look at what firms are telling us, both in the Business Outlook survey and directly, we're more convinced than the Reserve Bank is that we really are in an environment where firms are finding it really difficult to pass cost increases through, where wage pressure is dropping. And although there's not too many runs on the board, we do expect that domestically generated inflation to start to drop away more meaningfully quite soon.
Last month, the Reserve Bank sounded quite hawkish, and you said then that the risks were towards a cut being earlier than May, which was your previous call. What sort of changed and nudged around since then?
Of course, the Reserve Bank themselves pushed their estimate of the first cut out from May. We were in roughly the same spot to August next year, which is an exceptionally long time away. So their take on it was that productivity growth has been weak and the domestic inflation has been higher than they thought. So you put those two things together and you reach the conclusion that actually there's probably been less spare capacity in the economy than they thought. Now, that's one possible explanation, but when we delve into the details of non-tradable inflation, yes, there is a lot of persistence there, but in our view, the vast majority of it simply reflects the fact that a lot of prices have lagged impacts on them, whether that's lagged construction costs and wages in the case of insurance, for example, or it may be actually CPI inflation itself in the case of tobacco, indexation of taxes, for example. So those sorts of things, they don't imply that you need to have more pain in the economy to achieve your goals, that you just have to be patient. So fingers crossed.
It's interesting that a big chunk of the inflation at the moment is what you call domestic and often linked to either housing or government fees and charges or rates, insurance, things which aren't very responsive to the official cash rate. Is the Reserve Bank having to push extra hard just to get that last mile of inflation back in?
They've certainly talked that way in the last monetary policy statement. In our view, while those things are less responsive, they're not unresponsive. If you look at insurance costs, for example, a lot of the increases are related to increasing replacement cost for a house, for example, and that's hugely to do with what's happened to construction costs. That is something that absolutely the Reserve Bank can have a big influence on, for example. So insofar as they have had an impact on that, construction cost inflation has come down, you would expect insurance premium increases to also be lower going forward. But it does all take time, and the Reserve Bank separated the different types of price moves into ones they can influence quickly and ones they can influence slowly, and then also things they can't influence at all, like the weather, for example. It is a mix of things, and it is fair to say that is all taking a while for monetary policy to work. But we would certainly push against any notion that monetary policy is not working or not getting traction or that something is broken. It's just taking time.
And once we get to that February cut, how many cuts do you think the Reserve Bank might have to deliver to get to somewhere near neutral?
One thing about economic forecasting is we all expect things to get to some mythical equilibrium that, of course, never arrives because life keeps happening in the meantime. But our best guess as to where neutral is around 3.5%, so we've just penciled in one cut at every meeting until then. So there's a lot of uncertainty around that, obviously. We've seen some central banks deliver one cut and sound very uncertain about whether they're going to deliver any more. Others deliver a cut and strongly suggest that that's the beginning of a series. So I think central banks probably want to feel their way fairly cautiously, but of course the tendency of markets is to run away with wherever things are going. So I think the Reserve Bank of New Zealand will be quite aware of that risk as well, and as such they don't have a strong incentive to signal rate cuts well in advance of when they actually are confident that they're going to do it. It's likely to, in practice, their confidence is likely to turn more quickly than they are forecasting, and our take is that that will be in February.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, June the 11th. Catch you tomorrow with a look ahead to Australian jobs data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.